When you think about legendary investors like Warren Buffett, you have to wonder how they do it. Well, a lot of it comes down to a checklist, a simple, systematic way to find great companies without overpaying. So today, we're going to borrow that mindset and apply it to a big name in the financial space, Prudential. We're going to see if it checks all the boxes.
Okay, so here's our game plan for today. We're going to walk through the 6-step checklist. First, is the stock on sale? Then, is the business actually any good? We'll see how they treat their shareholders, calculate our safety net, do a little detective work, and then wrap it all up with the final question. All right, first things first, are we getting a good deal? The whole idea of value investing is to buy a dollar's worth of a company for, say, 50 cents. So our first job is to figure out if Prudential is trading at a discount. And for that, we'll start with the classic, the P/E ratio, or price to earnings. It's basically a price tag. It tells you how many dollars you have to pay for $1 of the company's profits, and generally, a lower number is what you want to see. And wow, okay, the numbers here tell a really interesting story. Just look at that P/E ratio. It's sitting at 9.48 right now, which is less than half its 3-year average of almost 23. And it's not just a one-off. You see the same pattern all the way down. Price to book, price to sales, price to free cash flow, they're all way below their recent history. The data is pretty clear. On paper, the stock looks cheap. That's a big checkmark for step one.
But here's the thing, a cheap price tag on a bad business is just, well, it's a trap. As Buffett famously said, it's better to buy a wonderful business at a fair price than a fair business at a wonderful price. So the next big question is, how profitable is Prudential really?
A fantastic way to measure this is with return on equity, or ROE. Think of it like a report card for the management team. For every dollar shareholders have invested in the company, how much profit are they generating? And right now, Prudential is delivering a solid 10.90%.
But what's really powerful here isn't just that number, it's the trend. That 10.90% is a huge jump from its 3-year average of just 6.73%. So this tells us the company isn't just profitable, its profitability is actually accelerating. And that is a very, very good sign, another checkmark for us.
So it's profitable, that's great, but as an investor, you got to ask, what's in it for me? Well, a great business often shares its profits directly with its owners, and the most common way they do that is with a dividend, a regular cash payment.
And Prudential makes a heck of a first impression here. Its current dividend yield is a very nice 5.90%. I mean, just to put that in perspective, that's the cash return you get every year just for owning the stock, way better than you'll find in most savings accounts. But a high yield is only half the story.
Because what's even more important than how much they pay is how reliably they pay. And this is where Prudential really shines. They've increased their dividend for 17 years in a row. Think about that. Through all the market ups and downs, the checks to shareholders just kept getting bigger. That screams financial strength.
And as you can see here, that growth has been remarkably consistent. The dividend's grown at about a 4% clip per year, whether you look at the last 3 years or the last 5. So you're not just getting a high yield, you're getting a high yield that's also growing. That's pretty much the holy grail for a dividend investor. A huge check for number 3.
Okay, now we get to what Warren Buffett calls the 3 most important words in investing: margin of safety. The whole idea is simple. You want to buy something for way less than what it's actually worth. That way, you have a buffer, a cushion, just in case you're wrong.
So to figure that out, we have to try and estimate what the business is truly worth, completely separate from its day-to-day stock price. One way we can do that is by looking at all the cash it's expected to make in the future and calculating what that pile of cash is worth today. That gives us an estimate of its fair value.
And this is where things get kind of wild. Just look at the slide. There is a massive, massive gap between the current market price and the calculated fair value. This analysis suggests the company could be worth more than 4 times what it's trading for today. That is an enormous difference.
So what does that translate to? It translates to a margin of safety of almost 80%. In theory, that means the stock price could fall from its estimated true value, and you still wouldn't lose money on your initial investment. It's a gigantic theoretical cushion. This is the biggest checkmark we've seen yet.
But hold on a second. A margin of safety that big is almost unheard of. It forces us to put on our detective hats and ask, what are we missing? Why is the market so down on this stock when our checklist is looking so good?
And this chart gives us our first major clue. On the right, net income, that's the bottom line profit, has grown at this incredible rate. But look to the left. Revenue, the total money coming in the door, is almost flat. So
How can profits be soaring if sales aren't really growing? It suggests that maybe this profit boom is coming from one-time events or cost-cutting, things that might not be sustainable.
And the stock's own history kind of backs this up. This has not been a smooth ride. I mean, look at this performance. It's all over the place. Up 45% one year, down 26% another. This kind of volatility tells you the market just has a really hard time figuring this company out, and it can be a painful stock to own if you don't have a strong stomach.
Okay, so we've run through the numbers, we've done a little digging, and it's a pretty complex story. Let's lay it all out and see what our Buffett-style checklist has really told us about Prudential.
So here's the final picture. The bull case, the story the numbers are telling us, it's incredibly compelling. The stock looks really undervalued, profits are accelerating, it has a rock-solid dividend, but the bear case points to the story behind the numbers. It questions whether that growth can last, and it warns you that you better be ready for a wild ride.
And that right there is the ultimate challenge of this style of investing. The numbers tell one story, a story of just immense potential value. But when you find a disconnect this big, the real work for an investor is just beginning. It's not about the checklist anymore. The final question becomes, what do you need to believe about this company's future to really trust that this incredible margin of safety is actually real?